charts out there where you'll see them and they have so many confusing and conflicting indicators. Honestly, it even confuses me. So don't feel bad if it confuses you as well. I really just like candlestick charts. And what's amazing is that within the candlestick charts, there are different formations that show up, like a bottoming tail, a topping tail, an engulfing candle, so these little things that show up that give you the likely scenario. And what I love to do is I just love to draw trend lines, and trend lines can tell you so much. Like, let's just take a look quickly at my chart here. And what we can see on this chart, right? So this is the S&P 500 chart. And what I love doing is just playing connect the dots. So if you just connect this high to this high, and then you drag that line out, look at what you get. So literally you had this high to this high, and it gave you this exact high, this high, and this high as resistance, or where to sell or short the market. And so again, little things like that are remarkable in terms of giving you the insight to kind of make the right decision. And I just, again, I keep it so simple. I use Fibonacci because it occurs in nature. I use moving averages, but I don't use a lot of things like stochastics, MACD, VWAP. I don't use any of that stuff, to be honest. For me, it's drawing trend lines, looking at double tops, double bottoms. Like it's understanding these kind of simplistic kind of things within the chart. But when you combine them all, they give you, I look at charts as being at any one point, there's a percentage of success rate, right? There's a probability of success. So when you get a trend line to hit and you have a time factor, like a 7 count, which is getting a little bit more complex, but it's in some cycle work, or if that trend line is also at a Fibonacci retrace, it's really about putting the pieces of the puzzle together and aligning where you have multiple factors. So a factor could be a double bottom with a bottoming tail right there. 2 factors will push your probabilities of success up significantly. If you get 3 factors, it's even higher. And so it's really about just keeping it simple, but also recognizing that you don't just want one trend line to make a decision for you. You want a trend line or something else. You want 2 or 3 factors that'll give you that high percentage chance of a win. Progression, right? I mean, I started out doing everything wrong, where I let my emotion kind of dictate whether I was jumping into a stock or a crypto. Well, not crypto, because that came later on, but more stocks and commodities. And so, I would chase stocks that were already running up, and I'd wonder why, I would be in the money for a little while, and then it would ultimately end up being out of the money, and I'd take a loss. And I couldn't figure out why. And then as over time, you start to recognize what you're doing wrong. Like having a trading journal is so important early on in your career, because what you'll do is you're writing down what trade you didn't make money on. And those are always the most important. And then you want to write why. What did you do wrong? Well, I bought it when it was already up 50%. So it was already running up, versus buying at a downsloping key trend line, for instance, of support. And so you have to be someone who's willing to admit that you've made a mistake. You have to be someone who's willing to really learn from those mistakes and write them down, and really understand that you're going to make mistakes. But as long as you're improving and learning from them, your curve towards profitability gets shorter and shorter, and you'll go more vertical on profits. My career being 20 years in, I don't do a journal anymore. But when I was younger, I did one that was a paper journal. And the reason why I did that is because it was something I could keep right next to my bed at night. And I found it very helpful that before I went to sleep, I would always make sure to make those journal entries, think about the trades from the day, and then write out, okay, what could I have done better? What did I do wrong? What did I do right? And then looking at it on a weekly basis, right? So when Friday came around, I would then review from Monday and kind of reinforce those kind of rules about what I did wrong. Okay, don't chase, don't buy, here, don't do this. And I think that reinforcing of having it right by your bed really leaves it in your mind when you go to sleep, and it makes it more likely that you're going to kind of absorb the lessons. So like the charts don't change. If you could look at a chart going back to the 70s, 1970s, the 1920s, I mean, charts don't change. It's that we as humans, we tend to want to always, we have this greed and fear, right? We're ruled by greed and fear, the 2 most powerful emotions. And so it's a matter of learning to control that and saying, listen, if I'm going to be a successful trader, I can never be greedy or fearful. I always have to be neutral. And by being neutral, you then decide, okay, now I can look at the chart with no bias and look for specific factors that will trigger me to get in or get out of a chart. And I think that's the key, is that as soon as we let that emotion creep in, it then becomes an emotional trade. It's where the market will eat you alive, because it's going to feed off that emotion and push you to your extremes. So that's a great question, because I think as a trader, the traders that adapt as quickly to a changing market as possible are the ones that will survive, right? So we just went through this epic bull market in 2021, going into kind of a bear market in 2022. In 2021, bad news didn't really matter and everything just went up. So there were technical ways of trading where you could buy almost any dip and you would make money. As soon as we hit the bear market, that didn't work anymore. And so as a trader, you have to be able to recognize those changes. And just like you're saying, there are things that worked a year ago that won't work today. And again, you have to, as a trader, recognize that as soon as possible and adjust for that. Because again, if you're stubborn, and listen, I'm a stubborn person, but I've learned to be a robot in trading, you then will adapt and make money in no matter what type of market you're in. So I mean, there's definitely things that don't work as well. One of my policies is that if I have a technique, like let's say there's a setup that I love taking, if I lose on it 3 times in a row, then I stop that for a while and will reevaluate. So I'll still look for that signal, but I'll keep track and I'll kind of keep a log of whether it's working or not. And then if it starts to work again, a high percentage of the time, I'll go back to it. But once it fails 3 times in a row, I kind of step back from it. Once something fails 3 times in a row, I basically just paper trade the pattern, right? So at that point, there's no way I'm going to commit more money to any sort of setup. It's more just saying, okay, let me see. I see this in the chart. It failed 3 times in a row. Let me just follow it and check back in tomorrow. Did it work this time? And ultimately, what I look for is trades that work out or setups that work out 70 to 80% of the time. If it's 60%, it's too close to gambling. 50-50 is gambling for sure. And so you really want to find those setups that are 70 to 80%. So it has to prove to me that it's successful 70 to 80% of the time again before I step back in and we'll try it again.